Hello, my name is Robert Lyon. In this video, I'm going to be teaching you all about SMT divergence and how you can use it to make a lot of money in the markets. Why, you ask? Because I want you to make a lot of money. So this is a very cool trading strategy. Okay, there's a few reasons that I really like this. It has clear rules. It's a game changer to catch breakouts. It's an amazing way for you to have a 80 to 90% win rate, so you can add this to your trading plan so you can be very successful, and it'll educate you on a better way to trade and view the market. Okay, so SMT Divergence Strategy, that's what this is. So the way that I use this specifically for my trading strategy is I do it between the S&P 500 and the NASDAQ. Now you can also do this for gold and silver. You can do this for Bitcoin and Ethereum. You can do this for oil and gas. You can do this for certain currencies. The main thing is, like, if you look at the S&P 500 and you look at NASDAQ, you can definitely tell, like, they run pretty similar, right? They're almost like parallel to each other, even though they're a bunch of different companies and they have a lot of other things going on. Man, it is just dumping right now. The big things that you're going to see is whenever you see one of these SMT divergence, like this big one right here, so you see how it kept going up, whereas the NASDAQ was very level. And then as soon as we did hit that level, or we did see this SMT, boom, we had this huge pivot. We had this huge sell-off, right? So that was my indicator to know that I should look for a trade and get in. And that this is also your indicator when you see these SMTs that there's a good chance that the market's about to make a serious change. And the biggest ones are really when you see ones that also come after a fair value gap, right? So like we have this one, we have this large green candle, same thing here, and there's a little SMT divergence between the S&P 500 and here, and it was when they were coming back into this inner liquidity, okay? But an SMT divergence is just when the two pairs that are correlated happen to not correlate at the same time. What does this tell us, and why is this a big indicator? Well, this tells us that the market makers, the big money, have kind of chosen to put more of their money, or there's a bigger move happening, and it's a signal that money is going into one or the other, right? I specifically only trade NQ, so I'm really only looking to use this strategy when NQ is either more powerful or is more bearish or more bullish than the S&P 500. But you can really use this as an indicator for a big change in price direction, an entry point for your trades to start looking to make some money. There's a lot of things that you can do, okay? But it's just a great way to make some money. So let's get into this presentation. I'm not going to try and bore you too much, so I might breeze through some of these. I will make more videos though on this, okay? What is an SMT divergence, and how does this strategy work? In this video, we're going to go through 4 key chapters. We're going to go over what is internal and external range liquidity. We're going to go over the time frames that you need to learn how to use to understand this model better. We're going to go over what SMT divergence is, and we're going to go over how to execute and how to manage your trades. So again, why this strategy has a 90% win rate, which is insane. So that means that if you just stick to this strategy that I'm about to teach you, and you show up every day and you implement, you will win 9 out of 10 times. Okay, there's always going to be that one that gets away from you, and I'll show you some of those. But this is a really cool option for anybody who doesn't have a solid strategy. Okay, that's why I'm making this video, and I am doing this because I want you to make a lot of money. All right, it has simple to follow steps with clear rules. If executed correctly, you will be profitable. This model works for all markets. Again, that's another cool thing. You can do this for stocks. You can do this for Forex. You can do this for crypto. You can do this for futures, right? I only trade futures, and I take the money that I make from futures and I put it into crypto, okay? I am thinking about doing some penny stock stuff, but I just don't have the bandwidth. I'm too busy with all my other businesses, so I solely focus on the NQ futures, and then I take all those profits and I dump them into meme coins, and I'm trying to make $1 billion with that simple strategy. So first of all, what we're going to be talking about is internal range liquidity and external range liquidity. Internal range liquidity. Okay, I'm just going to show you an example of what it's like, what I mean by internal range liquidity. So whenever we see, like right now, we are breaking to the external range liquidity. So internal range liquidity is the liquidity that was made inside of this bar, let's say. Okay, so all of these bars all the way up until this green bar is inside of the internal range liquidity. Okay, so we had this big move down, and then we went back into the internal range liquidity. And the reason that internal range liquidity matters and it exists is the market makers, okay? The people that are booking the numbers inside of the trade, inside of the stock market, or inside of the market, whatever, they have all these contracts, okay? And when the market just literally like dumps like this, all of the sell contracts are getting filled, okay? All of the sell contracts are selling like crazy because somebody is calling their broker and saying, sell, 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 okay? And then when that happens, there's an imbalance, okay? Biggest thing that you really need to learn and that you should understand today is that the market only moves for two reasons. Okay, number one, they are trying to rebalance, or there is an imbalance, okay? Or number two, they're aiming to take out old highs and old lows, okay? Those are the only two reasons that the market move. But when we have one of these big moves, there's going to be internal range liquidity. Liquidity just means action, okay? There's internal range action. There's contracts that need to be filled that did not get filled. We almost are always going from internal range liquidity to external range liquidity. So you have a big bar, and we have to go back into the internal range liquidity to fill out those contracts, and then you're going to break out to the external range liquidity. External range liquidity is all of the contracts that are sitting on the outside of the internal range liquidity, okay? And the reason that there's a lot of liquidity on the external range of liquidity is because there's a lot of people that want to get back in at this certain price point, or there's a lot of people that have their stop loss sitting at this certain price point. And the maker model and the buyers and the people that need contracts, there's only a certain finite amount of contracts that they can sell. So whenever there is a large amount of contracts that can be filled, the market is going to go there, fill those contracts, and then it's going to go back down to internal range liquidity. But basically, internal range liquidity inside of big bars, inside of large price action, and then external range liquidity is when you break outside, okay? And the market is almost always going from internal range liquidity to external range liquidity, okay? So on the way up, we have this big move, and then we come back and we have close all these contracts and do our work from internal range liquidity, and then boom, we're going to take out a new high now. Boom, boom, boom. Okay, the market is always expanding, consolidating, expanding, consolidating, okay? That's the big things, at least if you're in a good market. So here's a couple examples looking at the charts. External range liquidity, boom. Everything inside of here is now internal range liquidity until we break out to external range liquidity. And we come back down into internal range liquidity, break out to even higher external range liquidity. Same thing. Here is the internal range liquidity. You see all these candlesticks? So whenever we come back into these candlesticks, you are now going back into internal range liquidity. Once all of the internal range liquidity is satisfied, we break out to external range liquidity. All right, this is what the market is almost always doing. Now let's talk about SMT Divergence, or Smart Money Tools. That's what SMT stands for. I honestly, until I was making this video, I thought SMT stood for something way cooler. But I think Smart Money is just a kind of ICT concept, and this is a smart money tool. So that's what SMT stands for. So what is it? SMT divergence is the crack in correlation between assets at key highs and lows. Okay, so it is the crack in correlation between two assets at key highs and lows, meaning it will give you a glimpse, it will give you a crack to look through that there's about to be a big move. That's the biggest thing, okay? At the highs and lows. Why is this important? It's important because it allows you to identify which pair is the strongest or the weakest. Very powerful. In a bullish market, you want to be longing the stronger asset that would make a higher low compared to correlated that would be a higher low. In a bearish market, you want to be shorting the weaker asset that makes the lower high compared to the correlation of the other assets. Very, very powerful. Okay, so here's an example of a bearish SMT. So you see how on this on the right side, the high is way up here, whereas on the left side, the high is here. This is an SMT. And then as soon as we see this SMT, boom, we have this massive price breakdown. Here is a bullish SMT. All right, you see how this one is lower and this one's higher? So if we know that we're about to go into a bullish, we would want to be inside of this one on the right. But you see how these SMTs are key indicators before large breakouts. If you see an SMT, it's a good chance that you're about to have a big move. Here's the SMT to this, from this high to this high, and this high and this high. Another one. Now let's talk about time frame alignment and the market maker model. Okay, what is a time frame alignment? Okay, so there's different times that you can be looking at these candles, right, to find your SMTs. Okay, this is how you break this down and keep it simple. Okay, when you're looking for market maker models to form, you must understand that the time frames that are formed are from PD array at the subordinate time frame. Yes, the markets are moving the same, but you're going to get different way of looking at it depending on which time frame you're looking at it. Okay, so the important thing to understand here is that certain time frames are linked to each other. Once you start utilizing the structure and format from trying in your higher time frame narrative, then when you start from the higher time frame, then you go down to the lower time frame. This is going to increase your win rate. All right, so these are the time frames, and this is how it works, okay? So if you're viewing key levels on a monthly scale, if you're trying to enter a trade, you would break it down and you'd get to a smaller state of daily. If it's weekly, it goes to 4 hour. Daily, it goes to 1 hour. If it's 4 hours, you go to 15 minutes. If it's 1 hour, you go to 5 minutes. If it's 15 minutes, you go to 1 minute. Okay, so what I do in my trading is I look at the weekly, then I look at the 4 hour, then I look at from the 4 hour, I look at the 15 minute, and if I see a good entry, I'll jump to the 1 minute to actually enter into my trade. But these are correlated. This is how it works. So you're not gonna see an SMT set up on a 1 hour and then try and enter on the 1 minute. You would look for your entry if you're looking on the 5 minute. Monthly, right? So you see this fair value gap or whatever the hell this is. You see this on a monthly, and then you want to scope in closer. Now you see it on a daily. Okay, and you'll be looking for a trade. You look in on the daily. Okay, now that you've seen it on the daily, now you're going to look at it on the hourly, and you see an SMT right there on the daily. So first you see the SMT on the monthly, then you scroll in and you see it on the daily, right? First you kind of see it on the monthly, but then you zoom into the daily and you start to see that we have an opportunity here. Then you scroll in on the daily and you actually see an SMT. Then you're going to look at the 1 hour, then you're going to look at the 4 hour, make sure it's still there. Then you look at the 15 minute. And then you're going to look to enter your trade either on the 5 minute or the 1 minute. Okay, so what is a change in state of delivery? A change in state of delivery is simply when the market changes trend from bullish to bearish. So we go from green to red, bullish to bearish, or bearish to bullish. Either one of those, okay? Red to green. These are how you identify the beginning of the formation of a market maker model. When you're looking to identify a change in state of delivery, you want to wait for price to reach a key level. IRL, ERL, on the subordinate aligned higher time frame. One factor that will confirm the change in state of delivery is when you see a price has an SMT divergence when you tag into an inner range of liquidity or an external range of liquidity. So you're really looking for SMTs either in those internal range liquidities or in those external range liquidities, okay? And you're going to be looking for these on the higher time frames, meaning the weekly, daily, 4 hour, maybe even 1 hour. You're going to have to look at those first. If they do not see anything on the higher time frames, you do not pass go. You do not go down to the lower time frames to look for a trade. Okay, so this is a bullish change in delivery. So you see this big green candle bar. Whenever you're setting up for one of these trades, your entry candle bar or your order block is going to be the candlestick that just broke to the newest low before, or the newest high before the SMT, okay? I know that's kind of confusing, but we'll try and keep beating it into your head so you know what to do. This down close is the candlestick, is your order block. Okay, it takes out a key level of an old low, then price closes above the body, is a highly creative, okay? And then you see on the right here, as soon as this candlestick closes above our order block, we're going to start to set an entry, okay? Now we're going to go to our lower time frame. We're going to look for an entry. When price closes above the down close candle, again, this is for bullish, that is a confirmation of the change in state of delivery, but also creates an order block that can be utilized as an entry for longs as labeled, okay? So we're going to, as soon as we stop above this, we put our entry in, and then we're going to put our stop loss at the bottom of this as well. And then we're going to let it ride up for a 2x return, depending on whatever your trading rules are. Same thing for a bearish change in state delivery. This is an up close candle. This is a bearish order block. This is a bearish order block. And basically, as soon as we see this, as soon as the candle stops below this, we're going to be looking for an entry. Order block, SMT divergent candle. As soon as the next candle stops below this one, we're going to be looking for an entry. Note how when the price closes above the up close candle that has been labeled, same process for bullish scenarios and bearish. And then the market's just going to go. So rules for entry. Price needs to reach an internal range liquidity pool or external range liquidity. There has to be something that the market just went to, and then the SMT is created. There has to either be a fair value gap. It just basically cleaned up all the candles that it left orders open on at the top or at the bottom. And then now there's an SMT. Boom. Now we're looking for an entry point. Okay. Price needs to have SMT divergent on that internal range liquidity pool tag, or at the level or inside. Once you have those two things, you have to see it first on the higher time frame. Monthly, weekly, daily. I add the 4 hour in there as well. Okay, if there's a clear internal range liquidity or a clear point of interest where it just happened, now you can start to go to your lower time frames to look for an entry. Identify market maker models and putting it all together. So number one, price has to reach an internal range liquidity pool. Okay, the best entry points are going to be when there's a fair value gap and we see an SMT happen, because that's going to be our time to pull the trigger, right? That's going to be our aha moment. That's going to be the, hey, time to start looking to make some money, right? Right. So once you have the internal range liquidity or external range liquidity, and then you see the SMT, you're going to look for that SMT on the higher time frames. Okay, you're going to look on the daily, the weekly, the monthly, the 4 hour. Okay. Once you see that there is a point of interest, okay, either an internal range liquidity, external range liquidity, and there's an SMT. There's an SMT divergence. Now you can go to your lower time frames, okay? You're going to go to your lower time frames. You're going to wait for price to provide a change in state, meaning it's going to go from green to red, red to green. So you're looking for the change of state, and then you're going to wait for the order block, okay? And then you're going to execute off of the order block that sweeps liquidity, and you're going to have it create the SMT and the change in delivery. Once the new candle closes above the order block, you are going to enter your trade, right? Or you're going to set your trade to be entered, and you're going to put your stop loss below the candle that is your order block, and you're going to set your profit at a 1 to 2 risk to reward. And then you can close 80% of your positions at the 1 to 2 reward, or you can even move it to a stop loss, break even, and then leave 20% running as long as you want till it hits external range of liquidity. Now let's go over some examples. Okay, so here we see this SMT, low risk, smart running reversal. Here's your order block. Okay, as soon as this closes, you're going to enter. You're going to see that it breaks out, it comes back, retests, but your stop is down here, and then it just takes off to the races. Okay, and you can either take off your 80% at, a 1 to 2 reward, or what I like to do is I'll usually enter in like 1 to 3 contracts or 2 to 3 contracts, right? So I'll enter this in, boom, I'll take off half, and then I'll just let the other one run, right? And those are not micros. Now let's talk about execution. If step 1 and 2 are checked off, again, that's if on the higher time frame you can see that there's an SMT and that you just hit it a point of interest. Okay. Then now we're looking for this SMT, right? We see the SMT. We see that the external range of the liquidity. We broke into the internal range of liquidity, and now we're going to break out to the external range of liquidity. Now you're going to focus on the price action. Now you're on the lower time frame. SMT, order block. Finally stop above the order block. We're going to enter our trade right here. Okay. This is the aligned time frame candle that sweeps liquidity and creates a higher time frame for the SMT. And again, we're looking at the body. I do typically put my stop loss at the wick on the bottom though. But at the top, I'm looking at entering at the body. Boom. Off to the races. To the moon. Right? And you see how sensitive, as soon as we park above that, we come back down, we test it, bam, off to the races. Big profit, big way to make a lot of money. All right, let's draw up this one now. Same thing. Let me know if you see it. Let's mark it up. Where is the SMT? I hope you see it. Pause the screen if you have to. All right, we see it right there. Instead of going up, this one's going down. Okay, number 1 and 2 is checked off. Weekly IRL, 4 minute. Now we're going to come back in here. Look familiar. Let me see this order block. Off to the races. Enter yours for 1 to 2. Or you see how it's seeking liquidity up here? Boom. It's seeking the external range of liquidity. So as soon as you see it stop above this, blam, off to the races. Okay, final notes. Weekly prep, execution, weekly journal. Okay, so you can look at multiple pairs on Sundays, and you can decide which one of these have a very exciting internal range of liquidity that they look like that you think is going to hit, or you see SMTs that are going to hit on Monday, or anything like that. So you can really analyze a few of these. I again only trade NASDAQ, so I'm really only looking for this move between the S&P and NASDAQ, okay? And then on average, I'm seeing 1 to 2 opportunities per day for this trade, okay? Some days there are none. Some days there's not enough volume. It's just no big reversals. It's just a very trend day. But for the most part, you'll typically get 1 to 2 of these moves per day, which if you hit it right and you stick in this thing and you stay in the trade, these are multi-$1,000 moves that you can catch. Okay, so you now have a way to enter these trades with a 80 to 90% chance of risk, which is very, very good, much better than almost anything else out there. And then finally, whenever you trade, I try and journal daily, right? I journal daily on how I did. I actually journal before I start trading to just kind of check where my mind's at and review the markets and talk to myself a little bit, and then I journal at the end of my trading, just going over, did I do good? Did I stick to my rules? Okay. All right, I just want to go over a couple that I did this week. Man, we were just fucking dumping. Crazy. Again, this is how I have my setup. I'm looking again for moves with the NASDAQ and with S&P 500. Okay, so this is the one that I caught on Wednesday. Yeah. I did one on Thursday too. Let's see if there's an SMT here for the dump. There was. Okay, let's look at that right now. So first of all, we're going to see, did we hit a point of interest? And the answer is yes. We actually hit this gap right here. So, and we also hit up here. There is a kind of a fair value gap from this dump that we had way back on Friday. But you see how, blam, there's unanswered liquidity here that we had to hit. We hit that, and then the SMT doesn't really show up though on the 4 hour. Let's just see if it's on the daily or something. So you can see it on the daily here. So on the daily, we see this SMT between right here. All right, so you see how this one is a lot higher, and then this one is just kind of flat. All right, that's an SMT. Not a crazy one. Might also be another one that I don't see. I mean, the other one is right here. You see how this one is absolutely flat, and then this one has this little up movement. Okay, so then we see it on the daily. So then if we go back to our little presentation, if we see it on the daily, then we're gonna go down to the 1 hour. So let's look at these on the 1 hour. Let's see if we see it on the 1 hour now. I mean, I see it right here. Here's today's SMT. We see from there to there. Boom. Tanks. And then we see that this could be our order block. So our order block on the NASDAQ would have been right here, basically. And then as soon as we close above it, we would have entered in probably over here. And we came back into the range and then absolutely just dump. Let's look at another one though. This is a very clear one. So this one's a little bit better example. Okay. So you see the SMT. This is on the 15-minute down here, by the way. So we saw it on the daily. We saw it on the 1 hour. Now we can clearly see it on the 15-minute. Big SMT diversion on this one. And as we can see, there's a big move afterwards, okay? Our entry point would have been right here. We really would have wanted to enter on the S&P because you can see that it's the weaker asset. So it actually ranged down a lot more. Our order block would have been like right here. As soon as we stopped below the order block, we would have got in, came back, retested, boom, absolutely just take. So these are just a couple ways you can start looking at it. Again, typically how I have mine set up is I'm just looking at the 4 hour on, and then I'm looking at the 15-minute on here. So I have same screen, same stuff. This is just how I have it set up when I'm just looking to play this SMT divergent. Okay, when I'm typically trading the NASDAQ, though, I'll have 1 minute, 5 minute, and then the 4 hour up, just so I can see different things. And then I trade on the 1 minute. I have found the 2 minute to be a little less aggressive, which is nice, but I trade on the 1 minute. Okay. But that is the video on SMT Divergence. I'll do some more live streams, some more live trade breakdowns of this concept because I think it's super powerful. But I hope you guys enjoy. I hope you guys see the power in what we got going on. I hope you guys enjoyed this video. I have a free school community where I like to put all these videos and organize, and sometimes I do live trades. live trading in the mornings. If you're interested in that, the link is down below. I look forward to talking to you in the next one.